For South African investors, the risks of investing in local assets can seem profound, especially given the backdrop of protracted load shedding, the recent troubles we've seen at SA ports, and of course, we're in an election year, and we all know that brings lots of volatility. Joining me today is Justin Fleur, Head of Equities at PSG Asset Management. So Justin, I think with the concerns around SA assets being so real and so profound, the question is, how do you think about South African assets? I mean, the trend at the moment is for people to really go offshore, but that is not a PSG Asset Management's view.
Oh, thank you, Audrey. So I agree, it's been a really tough time to be a South African recently. We've actually been increasing our exposure to South African assets, and I'll tell you why. So the first thing to say is I think you need a global perspective. So I think looking holistically around the world, you're able to position the different opportunity sets against each other. And when we do that, South Africa in its own right, relative to other opportunities globally, looks really attractive to us right now. So we've been increasing exposure, as I said. And there's a few maybe reasons for this. So the first one is the cycle. So what we see as being quite important is the broader dollar macro cycle, and it's linked to interest rates, inflation, and a whole bunch of other drivers. It's quite a long topic to talk about, but what's quite interesting for me is just they tend to move in about 10 to 15 years. Strong dollar cycles are normally tough for emerging markets, especially commodity exporting emerging markets and South Africa, whereas weak dollar cycles are very good and actually are a tailwind for sentiment in some of these markets. And what's interesting is we've just come off of a really tough 15-year strong dollar cycle. The dollar's been very strong really since the GFC. And we see signs that we are in the early stages of a weak dollar cycle. The dollar seems to be turning over here. And I think that could be very catalytic for emerging markets more broadly. Now, that could be positive for South Africa. So that's the one point, is the big picture. If you come into South Africa more specifically, I think there's a few big constraints that have been present on South African assets and sentiment, which we see potentially lifting or getting better. They're not going to go away completely, but they're going to improve. And I think that you can make money, quite a lot of money, just by that happening. And that would be around energy. So we see a reasonable probability that Eskom load shedding is going to be better in the future than it has been in the past. And that's primarily because the private sector and households, on their own account, with their own money, have basically invested in the space. So they've built their own solar panels, their own battery systems, and that has added to generation capacity in the country. So I think that's an interesting thing to watch. So I think energy constraints will be better in the future. The other one would be interest rates. So the local interest rate at over 8% is the highest it's been since 2009. And what we see is decent prospects that actually just comes in a little bit. It's not going to completely come down to where it was during COVID, but we see decent scope that over the next 2 years, you'll probably see some interest rate reductions. And that's going to be a very powerful impact on consumers, on corporates, and on sentiment as well. So those are two, call it headwinds, that are potentially going to ameliorate. The other thing to say is that our prices relative to history and relative to other countries are really low at the moment. So the market is embedding a lot of bad news. And our sense and our judgment is that the market's probably overshot. They're baking in too much bad news, and there's an opportunity in that. And if we look historically, whenever assets were priced like this, you actually made pretty good money in the next 2-3 years. So your returns were very good. And we see the ingredients for the same outcome here. And then the final thing to say is that positioning looks very much in your favor for a new investor. And what I mean by that is that a lot of investors have actually withdrawn their money out of South Africa. So you've had a lot of outflows from foreigners. You've had local selling. So local asset allocations are actually at the lowest than they've ever been towards SA assets. And a lot of them are sitting with reasonably high offshore weights. And we think that's a very interesting place to be. That's a very healthy place, because any incremental change to the dynamic that gets it just a little bit better or a little bit less bad can actually catalyze some buying and an appreciation in asset prices.
Justin, so taking that bigger picture perspective is really important in investing. But what does it mean for me as a South African investor? Do I simply go out and buy the local equity index, or is there more to it than that? How does PSG Asset Management think about this?
Yeah, it's a great question. I think we would be quite cautious about a passive approach to South African security specifically. And the primary reason for that is that our indices, our benchmark indices in South Africa are very concentrated to a handful of small companies, and most of them have nothing to do with South Africa. You know, they Chinese tech companies or global tobacco companies or global luxury companies, to give you a couple of examples. So investing in a passive ETF, for example, is not really going to give you South African exposure. Okay, so that's just the one thing to say. So what we would propose as a better alternative is active management by a company or a team of investors that have the experience to do it well, have done it for long periods of time, and have a systematic process for getting the odds in your favor over time. And I think a very important ingredient in that is just the ability to have a global perspective, to see where South Africa fits in with that, and to identify opportunities across the size spectrum. So you don't want to be too big. Very large asset managers actually have quite a constrained universe. So you want to be able to access the full breadth of the market, and then to do it in a way that can add value. And I think that would be the approach that we favor, and that's certainly the approach we try and execute on behalf of our clients.
When we started this conversation, we very much focus on risk and the riskiness of investing in the SA market. So can you give us an idea how you approach risk management in your portfolios?
Yeah, risk management is key, especially when the environment looks like this. There's a lot of global uncertainties and a lot of local uncertainties, and there's a lot of company uncertainties as well. So I think you need to have a systematic approach for dealing with that. So the way we would answer that question is we think fundamentally you got to do most of your risk management at the security level. So when you do your research, when you're pricing that asset, and you're trying to figure out if that asset is something that you want to own, you need to be looking at those risk factors at an individual level. Again, making sure you're not buying value traps or companies that look cheap, but actually are deteriorating and maybe aren't as cheap as they look. All right, so I think that's an important point. So that would be a primary point is due diligence, deep fundamental proprietary research is critical, number one. From at a portfolio level, the most powerful thing you can do is diversify. So we would say definitely have the appropriate amount of offshore assets, diversifying your South African exposure. You know, we would say it's very dangerous to be binary. So don't have too much South Africa and not enough offshore, but equally don't have too much offshore and not enough South Africa at these valuations. We think there's a big opportunity cost in that. That's also a risk. It's not having enough in something that's very cheap is also a risk. So we think a right balance there is the right way to go.
Justin, thanks so much for taking the time today to talk to us about this fascinating subject. Justin is also an author in the latest Angles and Perspectives, where we go into more detail on the subject. Thanks so much for joining me.
Thank you, Audrey.